Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches in the Sydney area and around Australia on the Community Radio Network. I'm really pleased to welcome back to the microphone one of my regular contributors, Natasha Panagis, from IFPA, the Institute of Financial Professionals Australia. That used to be called Taxpayers Australia. And what else have you been called in the past, Natasha?
Yes, there was Tax and Super Australia as well.
That's right. Yes. So welcome back. Good to see you again.
Thanks, Ray. Thanks for having me back on.
Wonderful. There's always something to talk about in the super space. And given I actually hold my own SMSF, today's a really topical issue because we're talking about comparing superannuation types. And then we're going to talk a little bit about investment strategies with SMSFs, which is, again, very topical because my auditor came back and I had a red mark against me. So I want to talk about that a little bit later on. So I guess given that IFPA is all about tax agents and I guess that next tier below the chartered accountants area, your advocacy in this space is really vitally important because the vast majority of the general public are going to be dealing with your constituency, aren't they?
Yeah. So with our members there, as you say, they're tax agents, they are SMSF auditors, super specialists, financial advisors who all help in that, giving that advice piece to their clients who, will have super funds in general, but SMSFs in particular. And it's about just keeping them up to date with what's happening in the super space so that they can then obviously provide quality advice to their clients as well, and advocating in this space as well. If we're seeing something that isn't working, then speaking to the regulators, whether it's the ATO or to the government or Treasury, about fixes to the system, that is certainly something that I'm heavily involved in.
And we'll get onto that a bit as well today. But look, today we're talking about some key differences. So self-managed super fund, as the name obviously implies, it is self-managed by the people that are in it. So what's the key difference between an SMSF and, say, an APRA fund, or as we might know, the very common advertising campaigns that are out there around industry and regular super funds? What are the key differences?
Yeah, look, all super funds have a shared goal to provide retirement benefits to their members. But there are some differences between self-managed super funds or SMSFs and other super funds. So if you're thinking about setting up an SMSF, it's worthwhile just comparing them against other super funds that are out there before you make your decision to get into an SMSF. So as you said, Ray, structure is one of them, is one of the key differences. As the name implies, an SMSF is something that you manage yourself, where you can have up to a maximum of 6 members in there. And in most cases, it's going to be your family members. But sometimes you might have people in business together who may open up an SMSF together as well. Right. So that's your next type of member mix. But when we're talking about other large super funds, whether generally these are APRA regulated super funds, and they could be things like retail funds, super wrap accounts, industry super funds, public sector funds for government employees. So all of those funds are considered large super funds. All of these funds will be structured as trusts because superannuation is a type of trust. And there will be a board of trustees that holds that legal ownership of the fund's assets on behalf of the members of the fund. Right. And so these large funds are going to be offered and run by large organisations like banks and investment companies and the like. So that's one of the key differences, structure. The member and trustee level is also a key difference. So in an SMSF, as I said, you can have up to 6 members in there, and all of them must act as either individual trustees or directors of a corporate trustee, and you've got to be actively involved in managing your fund. Whereas in a large super fund, there's generally no limit on the amount of members that can be part of that fund, and you're going to have professional licensed trustees managing that fund. There's a range of other differences like responsibility. As an SMSF trustee, you're expected to have knowledge on the tax and the super laws. You've got to comply by those laws. There's risk of non-compliance if you do the wrong thing. Whereas with a large super fund, if you're a member of a large super fund, that compliance responsibility lies with that professional trustee.
Yep.
Investments.
That's more a set and forget, isn't it, really?
It is. Look, investments is another big one, a big difference. In an SMSF, the trustees can create and implement the fund's investment strategy. And so, you know, they can make all the decisions regarding the investments they want, whether it's investing in real property or shares or managed funds. They have complete flexibility to do that. Whereas if you're in a large fund, although large funds do offer some control over the type and the risk profile of the investments that you can get into, you generally can't select specific assets in which your super is invested in. So, for example, you can't get into a real property, or you can't pick specific shares that you may want to invest in. Right. And there's some other differences as well, like insurance and who you're regulated by. SMSFs are regulated by the ATO, whereas large funds are regulated by APRA. And, you know, complaints and disputes. In an SMSF, the ATO doesn't handle any disputes amongst SMSF members. Any disagreements have to be settled through alternative dispute resolution methods or in court, and usually at the member's own expense, and usually no compensation available. Whereas in a large fund, you can lodge complaints with AFCA, which is the Australian Financial Complaints Authority, and you may be eligible to receive some compensation. So they are some of the key differences between SMSFs and large super funds.
Now, in the term self-managed super fund really does mean self. Do you agree that sometimes too many people are lulled into this idea of doing an SMSF without fully understand what they're really getting themselves into?
Yeah, I agree with you here, Ray. Many people don't realise what it means to set up their own fund and all of the responsibilities that come along with it. If individuals have sought advice from their financial advisor to set up an SMSF, then I think it may be safe to assume that this has been explained to them in detail. But because this is such an issue, the ATO has recently created publications and online education courses for people who are looking to start an SMSF. And this content from the ATO aims to help people to consider whether an SMSF is right for them by providing a comprehensive overview of the steps involved in establishing an SMSF, right from the initial planning stages through to fund registration. And, you know, for example, in this collateral that they're putting out, they explain, you know, what an SMSF is, what kind of structure that members can pick from, whether it's an individual trustee or a corporate trustee, an outline of their obligations, how other professionals can help them run their fund. And so there's all this information out there. And on top of thinking about setting up an SMSF, they've got other collateral available as well, like running your SMSF, winding up your SMSF. It's great info. It's really easy to understand, and it's available there to help trustees navigate the various stages of their SMSF life cycle. And for anyone that's interested in accessing this information, you can either do a Google search and search for ATO QC, which stands for Quick Code 67369. So ATO QC 67369, or you can type in that number in the ATO website and you'll get the info that you need.
I guess one of the things that I've seen, and I've had people from Services Australia, I've had ScamWatch representatives come onto the show as well. This is an area in the SMSF space where there's a lot of nefarious operators that I think lull people into the idea that, you know, they can buy property with their superannuation, and the lure is very, very high. And again, I had a discussion, because I'm a licensee myself, and I had a discussion where this particular person looking to become authorised said, look, we sell properties and we help people get into SMSFs. And I said, great, you know, do you obviously have financial planners that are advising these people? And they said, oh, no, not at all. There's no need. And I said, so let me get this right. Mum and dad operating their industry super fund, 3 months later have an SMSF with a limited recourse borrowing arrangement, and nobody's talked to them about their financial advice. And they go, oh, yes, absolutely. And I just sit there going, I don't think so. So I've had very short conversations with people seeking authorizations under my license, because I just look at that and go, my God, that is such a huge red flag. And I'm curious, do you see that kind of inquiry coming into the IFPA inquiry lines and support services that you do for your members?
Yeah, we do. And another key one is illegal early release, where, you know,
that was my next question. With power comes responsibility, and all of a sudden these SMSF trustees have direct access to their money. They've got a bank account with potentially hundreds of thousands of dollars. The temptation's really big, isn't it?
Yeah, it is. Look, sometimes people are tricked into doing it, rolling over their super fund balance from a large APRA regulated super fund to an SMSF, because as you say, Ray, there's this investment opportunity where you can invest in property and or they can invest in a range of other investments and be promised a great rate of return. So some people fall for that, and then they roll over their life savings to an SMSF only for it to be a scheme, and lose their benefits. So that's one thing, one way of getting caught out. The other way is deliberate, where it's an illegal early release. If you've got your own super fund, the temptation is high. It can happen. And unfortunately, it's very common where people are accessing their super before they're legally allowed to. For example, this year, the ATO released some data showing that about 66% of illegal early release relates to individuals who are entering the system, the SMSF system, with no genuine intent to run one. So the statistics showed that across a 2-year period, around $637 million worth of super savings left at the system illegally via SMSFs, right? Wow, and so breaking that up, I think there was about 381 million accessed in the 2020 financial year and 256 mil in the 2021 financial year. So really more than 600 million has left the super sector illegally through by SMSF trustees, and mainly through establishing new funds. So, it is this illegal early release to super is the regulator's greatest concern in the sector. And as a result of such behaviour, it's taking some significant steps and introducing a new program to, try and stop this from happening.
And the penalties, because the penalties are quite stringent too. They're big. They're really, really big penalties, aren't they?
Yeah, and that's just what I was about to say. The ATO continues to warn people that if they do this, they're going to face some serious consequences for illegally accessing their super. That could be things like being disqualified as an SMSF trustee, or having to pay additional tax, penalties, and interest. So there's just it's not worth it. And the ATO is saying, look, if you've done it, you can come forward and contact us via their voluntary disclosure service, and they will take that into account if you kind of dob yourself in a bit early when they're determining the penalties that may apply. And they're also putting the message out there to say, look, if you're aware of anybody that's running these type of schemes or have accessed their super early, then to I suppose dob them in using the ATO's tip-off form. So, that's up to you, but, that's what the ATO is certainly promoting.
I have a good story to tell, but we're going to go for a short break. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm Ray Trevisan, your host, with Natasha Panagis from the Institute of Financial Professionals. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Trevisan. I have at the microphone with me this week Natasha Panagis, a product specialist in the superannuation space from the Institute of Financial Professionals Australia. And today we are talking about types of superannuation funds, specifically the difference between self-managed super funds. And we're also going to talk a little bit now, moving into the second half, around investment strategies and wrap accounts. But before we went to the break, we were talking about the potential penalties about early withdrawal or illegal withdrawals. And I have a very personal account because I was given bad advice on my own SMSF over 10 years ago now, and I illegally withdrew money from my super fund to help a family member out. And unbeknownst to me, I started doing my financial planning course, believe it or not. And when I got to my SMSF module, I very quickly went very cold and went, oh my God, I have done something very illegal. And so I self-reported. I self-reported to the ATO and said, listen, guys, I think I've messed up pretty badly here. And again, the salient lesson here, Natasha, you were talking about this, the self-reporting line that the ATO have. I've got to tell you, the people that I dealt with were really compassionate. And I think they saw that I was very genuine in my remorse because I just didn't realize. And I had a bit of a nefarious accountant who had also fudged a few audits along the way, because if I had been properly audited, this would have been picked up. But anyway, to cut a long story short, in 2013, I got fined $85,000. Okay. Wow. And because I had self-reported, they reduced that down to $2,000 because I had self-reported. Now, many people around me just went, wow, you put a big tick in the W column for that one. But ladies and gentlemen, I can tell you, the ATO, if you are genuine and you self-report, they are very, very good about the whole situation. So I just simply put a flag out there saying, Natasha, I totally agree with you. Don't risk it. They audit, and the auditors and the financial reports are now done totally separately. So there's no conflict of interest. And so there's a lot of safeguards there now. We're going to move on to something else that's got to be done by trustees, and that's investment strategies. But I very quickly want to move into wrap accounts, because that's a new terminology that I think has really crept into the industry, particularly around APRA funds. Can you give the audience a little bit of an overview of what a wrap account is?
Yeah, sure. Right. So super wrap accounts, they're part of the retail super sector. They're designed to let investors consolidate various super investments in the one place. So these are online accounts provided to give you control over your super with a broad range of investment choices like managed funds, shares, international securities, TDs or term deposits, cash, things like that. And you can also get insurance within your super wrap account to help safeguard your retirement savings. But the term wrap refers to the streamlined, transparent way that these accounts hold multiple investments in a single super account, and that can reduce your paperwork and your administrative tasks. And it can also provide access to exclusive investment options that are not typically available to investors, things like wholesale managed funds and the like. But yeah, they're really quite handy. And over the years, super wrap accounts have become a really popular alternative to SMSFs because they offer a lot of the same benefits of SMSFs without the responsibility of being a trustee. So yeah, there's been a rise in super wraps.
Yeah, all the overhead of administration and understanding the regulations and compliance every year. And when I saw some of this, some of my own investment clients with OTG Capital showed me some of these things, and so I started doing a bit of delving. And I think it's a wonderful product development that the APRA funds have done, because I think it's a nice step between an SMSF and simply being very passive, where you only get really three choices, I guess, conservative, sort of middle of the road, and then aggressive. And people look at it and go, I want a bit more. So anyway,
absolutely.
We're going to move on to a little bit around investment strategies, which is an interesting one, because I've got a little bit of a bone to pick with auditors on this one, because investment strategies is something that, again, is being very focused by the auditors, because they're being told to by the Australian Tax Office, who regulate SMSFs. Natasha, explain to the audience what this investment strategy requirement is all about.
Yeah, look, it's a super law requirement that trustees need to adhere to. They need to prepare and implement an investment strategy for the members of the fund. So, as the name suggests, an investment strategy sets out what the fund can invest in, and all the investment decisions must be made in accordance with that investment strategy. So, the strategy is your plan for making, for holding, and for realizing assets consistent with your investment objectives and your retirement goals. So it's got to set out why and how you've chosen to invest your retirement benefits to meet these goals. And it's really important to make sure that this strategy is not a set and forget. It must be reviewed on a regular basis. And the ATO says that that should be at least on an annual basis, sometimes even more frequently if certain life events occur. So it is a requirement by the law, and there's a number of things that you need to give consideration to as well.
Is this something that, say, SMSF trustees should potentially go to a financial planner for?
Yeah, look, technically you don't have to go to a financial planner to create one, but they can provide valuable guidance, especially if you're unfamiliar with the superannuation legislation, the investment options, the tax considerations, and all of the regulatory requirements that are specific to super. You know, I touched on it just before, Ray, but there are a number of things that trustees need to give consideration to when they're setting up their investment strategy. Things like the risk and return, diversification, liquidity, you know, whether there are any liabilities to pay a pension from the fund, insurance requirements for members of the fund. So there's a good 5 set factors that trustees must give consideration to. And if you're not sure, you know, what they involve, then you know, you could potentially, you know, make a mistake and potentially, you know, fail or breach that provision in the legislation. So certainly, a financial advisor can help develop a compliance strategy that is tailored to your fund and your members' circumstances. It'll help you meet the super law requirements and can also help you keep your investment strategy on track as well.
I guess this is one of my little bugbears, is that, look, I'm a fund manager and I specialise in fixed income type of products. And I've said this to many people on many occasions. I'm hopeless at picking stocks. So when somebody says to me, you know, you should have shares, and I'm sitting there going, why? If I don't know how to pick a good share, or I don't know the right indices to invest in, I mean, my portfolio and my own SMSF, I can very proudly say, has been delivering double-digit returns since 2001. But every year I have this fight with my auditor that comes back and says, you're not diversified enough. And but I keep coming back to them saying, listen, my expertise is in fixed income. I can generate very, very good returns in this space. And by the way, it's not always risk-free, because there are risks involved with fixed income. But they say, oh, no, you need to have shares. And I'm looking at them going, guys, the share market's not always safe. And so I'm sitting there, there's this real dilemma, because a lot of the audit process tends to be box ticking. And so, you know, they'll sit there and go, not diversified. And I'm going, yeah, but it's in line with my investment strategy and it's delivering good returns and it's safe, yada, yada, yada. I wanted to pick your brains on that, Natasha. Is that something that you see coming back, that if an investment strategy does have a particular focus, let's say if the person's a very good gold investor or they're very good at investing in real estate, why do they need to go to shares? I'm just curious. Do you have a view on that?
Yeah, look, the ATO has been quite vocal on this, and it comes down to, you know, those 5 factors that I mentioned that must be given consideration to. Diversification and liquidity are 2 things, and so the ATO wants to see that your fund's investments or the member benefits are diversified, and you know, you're minimising the risk of inadequate diversification. So, you know, back in 2019, there were a number of SMSFs that invested in just direct property, and the ATO went on, you know, a mail-out campaign to say that you are not diversified. This poses a liquidity risk, and all of that. So, look, the ATO is the regulator of SMSFs. They're not, you know, they don't create the laws. They administer the laws. A lot of the messaging from the ATO is trying to, you know, provide, you know, an explanation of the requirements. And we've also seen the ATO in recent years to say an investment strategy that has, you know, 0 to 100% ranges in asset allocations is not a good enough investment strategy, because there's a lot of funds out there. Well, there's a lot of investment strategy templates out there that say, you know, here are all the asset allocation sectors that the fund can invest in, and it's, what can you invest in? You can invest in all these different sectors. from 0 to 100%. And the AHA is saying, well, it's not really an investment strategy if you don't really have a growth profile or a balanced profile. You need to make it more, specific to members' needs. And look, technically, you don't have to. You can leave it as 0 to 100. The law doesn't say that it needs to have a specific amount, but yeah, sometimes they do get too involved in the nitty-gritty of it all. So yeah, look, right, as long as you provide a reason for, if you're overweight or heavy in a particular sector, then you just need to say why you've invested that way, and if it meets your investment objective of the fund, then that's okay. You just need to provide a reason to say you've factored in all of those other considerations, and this is the decision that you've made for the fund.
And I guess the age of the trustees has a lot to do with it, because let's say, for example, if they've invested, a small business owner has invested in business real property for their business, and they're under 40 years old, and that's their big lump at the moment, because they've had to put everything into it to buy it. I'd sit there and look at it quite sympathetically and say, look, you've got another 27 years before you potentially retire or take an early, transition or whatever. But I guess from that perspective, they're all factored up when the auditor looks at it. But there is a tendency sometimes, because of the lower cost audits and they're trying to attract clients, I think there is a tendency to be a little bit box ticky, I guess is the terminology. But I think, as you rightly said, if you can sit there and justify it, but it's not something you can set and forget. And I think that's the big message, isn't it?
Definitely. That's the key message. Your investment strategy must be reviewed at least annually, and more frequently than annual if certain things happen, like there's been a huge market correction, or where a new member joins or departs a fund, because then you need to work out, does that investment strategy of the fund suit that member? And also when you start to commence a pension, you need to make sure that there's enough liquidity in the fund to be able to pay your pension payments. And as we're talking, if the fund has a property in there, that, assuming there's a solid cash flow there coming in from the property rental payments, that might be okay. But if there's a borrowing on it, or the lease or rental payments aren't enough to cover pension payments, then you really need to think about, is that the right asset to have in the fund? So yes, at least annual, but a little more frequent than annual if certain things happen.
And I guess just finishing off, there's other considerations around TPD and life insurance cover that the APRA funds provide some real advantages. That's maybe for another show. But look, we've covered some great topics today, Natasha. We're just about out of time. It's really fascinating. It's not simple. I think people that try and oversell this idea that, hey, anybody can do an SMSF. I'm here to say, and I really believe there's a lot of people in the industry saying that this is true as well. It's not for everyone. So be careful. I think, Natasha, you've given the audience some really great pointers. We'll have some of the interesting blog posts with the show. Natasha Panagis from the Institute of Financial Professionals of Australia, thanks so kindly for being on the show again.
That's right. Looking forward to the next chat.
Excellent. Until next time, thanks for being on Dollars and Making Sense. Bye.